Imagine a polished stranger sliding a glossy brochure across a cafe table. The headline promises zero tax, zero risk, written in the kind of font that makes bad decisions look sophisticated. There's a diagram with arrows that loop like a roller coaster, a photo of a sunset over palm trees, and a sentence that begins with HMRC/IRS approved. You nod, half intrigued, half terrified. Welcome to the world of gray tax avoidance schemes, arrangements that try to tiptoe along the edge of the law, not quite illegal at first glance, but designed to produce a result the law never intended. Tonight, we'll dismantle how these schemes really work, why they almost always collapse, and the risks they bury under lawyerly footnotes and marketing sparkle. So what does gray actually mean? It doesn't mean legal but clever. It means the paperwork is engineered to mimic compliance while defeating the purpose of the rules. These setups rely on fancy labels, loans, options, fees, trust distributions, partnership preferences, IP royalties, that disguise what's really happening. You earned money, and the scheme is trying to make it look like you didn't, or that somebody else in a distant time zone did. At heart, every gray scheme depends on a contradiction. It asks one part of the system to treat something as real, a deductible payment, a big loss, a tax-free loan, while it asks another part of the system to treat the very same thing as pretend. No corresponding income, no real risk, no real change in ownership. That contradiction is the fuse. It burns slowly, until it doesn't. If you've seen a few, you start recognizing the same 5 tricks on repeat. First comes the circular money loop. Cash leaves you and then boomerangs back through layers of trusts, partnerships, and offshore service providers. On paper, there are invoices and contracts. In substance, you still have the benefit. If money leaves as a fee and returns as a loan, that's a circle with a fake mustache. Then comes the phantom risk. Tax law rewards real risk, so gray schemes simulate it with non-recourse loans, guarantees from the same people on both sides, or assets valued by a friendly appraiser who treats monopoly money like legal tender. If you cannot lose, you aren't at risk. If you aren't at risk, the loss isn't real. The third move is the time machine, where losses appear today from transactions never designed to make profit later. Film finance that never intended to sell tickets, carbon credits with no credible market, or IP licensing where the royalty equals exactly the profit you wanted to erase. Fourth is the double story. The plan tells company A one version, this is a deductible expense, tells you another, this is a tax-free loan, and tells the bank a third, this is a routine transfer. When the stories don't reconcile, the case writes itself. And finally, the magic document, a counsel's opinion letter waved like a wand, carefully drafted to say something narrow and technically true. If all facts are as represented, rather than the thing you think it says, this will never be challenged and always works. Tax authorities collect these letters like baseball cards, and they do not flinch. Why do these schemes eventually collapse? Not because tax offices are omniscient, but because the modern system leaves footprints. Banks file suspicious activity reports. Platforms and marketplaces send data feeds. Employers, counterparties, and brokers issue forms that don't match your story. Treaties and information exchange networks connect dots that used to live on different continents. And then there are people. Whistleblowers who didn't get paid, promoters who fell out with partners, and clients who bragged on social media. Gray needs silence. The world is loud. Add to that the law's view from above. Most countries now have an economic substance doctrine, a general anti-abuse rule, or a judicial principle that says, in effect, if the steps are there only to create a tax result, we will ignore the steps and tax the substance. In the UK, you'll hear the Ramsey principle and the GAAR panel. In the US, the economic substance doctrine and step transaction doctrine. In many EU states, anti-abuse rules built right into directives. A scheme may be technically intricate, but the decision is often simple. Was there a real business purpose and real risk outside of tax? If not, game over. If you want to see the greatest hits of how they unravel, consider a few familiar plots. The disguised remuneration loan pays you through a trust that loans you your salary tax-free. Years later, tax law calls the loan what it always was: pay. The trust either seeks repayment, which you can't do, or collapses, and a bill arrives with interest and penalties. People sell their cars to pay loans they never thought were real. Or the contractor management shuffle. You invoice through a chain of offshore companies that skim management fees and return the cash as a loan or dividend from a place you've never been. The tax office matches your local client's deduction with your missing income, then asks where the work was actually done and where the company is truly managed. The answer, my kitchen, is fatal. Then there's the lost partnerships carousel. An LLC buys an asset at an inflated value with borrowed money that isn't really at risk. Paper losses flow through to individuals who shelter unrelated income. A court later says, there was never a realistic profit motive. The losses die, the deductions reverse, and the interest meter keeps ticking. Or the IP royalty back and forth. Your domestic company pays a royalty to your offshore company for the right to use a logo you invented in the shower. The offshore has no staff or office and licenses the logo straight back to you. Transfer pricing is supposed to measure real value, but here it smells like a loop. And the residency hop. You claim tax residence in a sunny jurisdiction because you took selfies on a beach for 90 days, while your spouse, kids, company control, house, and dog remain in your old country. The treaty tiebreaker asks where your permanent home and center of vital interests are. Your Instagram becomes Exhibit A. From the other side of the table, the auditor's playbook is surprisingly simple. The first move is mechanical. Reconcile third-party reports with your return. Do the payment forms match your declared income? Do the payroll and contractor lists match your filings? Are your bank deposits consistent with your low revenue? This stage doesn't need a detective. It needs a spreadsheet. The second move is narrative. The examiner collects contracts, board minutes, emails, and travel logs, hunting for a business reason for each step. If the only reason is reduce tax, you've walked into the doctrinal buzzsaw. The third move is leverage. Modern powers include accelerated payment demands, follower notices keyed to earlier court defeats of similar schemes, and promoter-purchaser penalties. You can keep arguing in tribunal, but you may have to pay first and fight later. The cash flow pain is the point. It dismantles promoter business models that rely on clients' appetite to litigate for a decade. And the real bill you don't see in the brochure? Back taxes are the headline. Interest is the villain, relentless, compounding from the year you filed wrong. Penalties are the plot twist. Substantial understatement, negligence, failure to file information returns, promoter-related add-ons, naming and shaming lists. If the facts show deceit, false documents, sham loans, hidden accounts, criminal charges step on stage. Even short of that, banks de-risk you, payment processors close doors, and immigration or professional license questions become awkward. The scheme promised asset protection. What it protected was the promoter's revenue. So how do you spot a scheme in the wild before it spots you? If the tax outcome is guaranteed, but the profits depend on a maze only the promoter understands, you're in danger. If the arrangement tries to make one thing be two things at once, income that's also a loan, a sale that's also not a sale, you're in danger. If the risk is theoretical and fully insured by parties connected to each other, you're in danger. If your participation depends on secrecy and speed, sign before month end or lose the window, you're in danger. If the plan only works because a piece of paper says blue is red, you're in danger. And what about the classic defense? But my accountant said. Good professionals can disagree on close calls. That's not gray, that's life. Gray begins when the design exists only to defeat the law's purpose. An opinion letter can reduce penalties in some systems if it is truly independent and based on complete, accurate facts. But promoters who sell 1,000 clones of the same plan aren't giving you independent advice. They're selling a product and calling it advice. Courts know the difference. So do tax offices. If you're already in, here's the grown-up exit. First, stop new transactions. Every additional step deepens your footprint. Second, engage someone who is not paid by the promoter and give them the raw truth. The best outcome depends on perfect facts. Third, quantify exposure. Unpaid tax, interest, and penalties under different scenarios. Fourth, consider disclosure programs if available. Some reduce penalties or criminal exposure in exchange for speed and completeness. Fifth, plan the cash flow. You may be able to agree time to pay arrangements, but you must be credible and responsive. Sixth, fix the underlying business reality so you never need the scheme again. What works instead, because you still want to pay less legally, isn't a secret at all. Use timing thoughtfully. Defer a sale until the next tax year. Accelerate legitimate expenses you were going to incur anyway. Structure vesting dates with eyes open. Use wrappers the law deliberately created. ISAs, pensions, QSBS-style reliefs where available, legitimate participation exemptions, real R&D credits for real development. Use the residence rules honestly. If you move, actually move. Home, family, management, banking, routine. Use companies for real reasons. Limited liability, investor credibility, benefit of corporate tax rates, backed by real substance, board minutes, decision-making, people, place. Use treaties correctly. Reduce withholding where the treaty says you can, not where a brochure promises you can. And yes, Hire a smart advisor to design this for your actual life, not for a conference slide deck.
If you're wondering why smart people still get caught, the psychology is the trap.
Schemes sell the feeling of being in on a secret. They promise that the clever few live on a higher floor of the building, where taxes don't reach. But the real upper floor is boring. Save into wrappers, spread disposals across tax years, document substance, align your company's mind with its mailing address, and say no to anything you can't explain to a sympathetic but skeptical stranger in 2 paragraphs. If you need an hour and a whiteboard to justify why a salary is a loan, you already know.
The good life isn't a spreadsheet, it's a feeling of ease when the envelope with a tax logo lands on your doormat. Gray schemes promise calm and deliver court dates. Real planning is less theatrical, but far more durable. It aligns with how the law is written and why it was written. It survives rule changes because it wasn't trying to cheat the spirit in the first place. It keeps your banker, your future self, and, crucially, your sleep cycle happy. So here's the rule I'd tattoo on your calendar. If a plan depends on everyone agreeing to call a dog a cat, you don't need a tax advisor. You need a leash. If a plan fits on 1 page, references rules you can actually read, and makes sense even if a judge asks, what was the non-tax reason? You're probably fine. And if you're tempted by a glossy brochure that says, 0 tax, 0 risk, put it somewhere useful, like under your wobbly table leg, and take the grown-up route instead. That route is not gray. It's clear, it's legal, and best of all, it doesn't collapse the moment someone finally looks.